In this video, let's talk about recently listed company Paytm. I will cover business overview, how does company make money, management traits, and finally stock valuation using discounted cash flow analysis. Let's start with business overview. Paytm is an Indian multinational technology company that specializes in digital payment system, e-commerce, and financial services. The graphic illustrates company's payment products and services for consumers and merchants. Company has full suite of payment services for both consumers and merchants, which enables them to make and receive payments in a convenient, seamless and secure manner both online and in store. Company provides various payments offering for more than 337 million consumers. The offering includes multiple options for users to pay all their bills on a single app like rent, utility, and invoices. It provides wallet linked with third-party apps for easy payments like QR code, Soundbox and POS devices. It also offers services like contactless payment, money transfer, syncing of contacts and chat options. From commerce and cloud services side, it provides various in-store and online services like ticketing, travel, entertainment, gaming, food delivery, ride-hailing and more. From merchant perspective, the company provides software and cloud services for various aspects of merchants' business that include services like billing and ledger, vendor management, customer promotions, catalog, and inventory management. As you understand various services offered to consumer and merchant, let's understand how does company make money. The company revenues are divided into three distinct categories. The first category is payment services. It mainly includes recharge and bill payment, money transfer and pay-in-store services. Company earns money from merchant as payment processing fee and rental for devices deployed. It charges convenience fee in select cases from consumer as well. The company earns around 70% of their revenues from these payment services. The next category is commerce and cloud business. It includes services like travel and entertainment ticketing, gaming, subscription and so on. Company charges convenience fee, platform fee or subscription charges to the consumer depending on services available. The merchant is charged with processing fee, hosting commission for games or distribution fee depending on type of services. Commerce and cloud business are contributing around 25% of total revenue. The third category is financial services. It mainly includes services like digital banking, wealth management and insurance. Depending on service availed, company earns money through payment gateway charges, brokerage, or sourcing fee. Financial services contribute around 5% of total revenue. The quality of company management is key factor on whether stock will be a good investment over long term. Here is the current organization chart for company senior management. The company is led by founder CEO who oversees the company's key strategic efforts including engineering, design, and marketing. You can research on other executives as well, but we don't see any specific red flags. However, I do want to mention on CEO compensation that the salary of 40 million, allowances and other perks seems to be on par with the highest known compensations for startup founders. You should keep watch on compensation, and it should be driven by future company performance. Let's talk about skin in the game now. CEO has around 9% stake in the company and this can act as great motivation to take rational decisions that benefits shareholders in long term. Another key factor to review is employee stock ownership plan. Employee stock ownership plan granted to management team outstanding as of today is around 9.66% of equity share capital. You should keep reviewing these numbers to ensure existing shareholders' equity does not get diluted due to excess stock-based compensation. As you developed enough understanding of business model and management, it's time to forecast business future prospect and value a company. We will estimate company value using discounted cash flow model. My DCF model is based on these key drivers and future expectations. Take rate is the fee charged on a transaction performed. Company current take rate is very low, which is around 0.79%. Management is prioritizing in acquiring users and transactions, and the company is expected to gradually increase take rate to 1% over next 5 years and then 2% following 5 years. This will help to estimate appropriate growth rate for future. As of today, company is losing money and has negative operating margin. As company grows, take rate improves. Economies of scale will push operating margin into positive territory and expected to achieve 5% in next 5 to 6 years and around 30% beyond 10 years. If you want to understand traits of money-losing company, head on to my video related to stages of business lifecycle under financial statement series. The other assumptions are related to capital expenditure, stock-based compensation and tax rate, which are in line with companies' past results and comparing with similar companies in other geographic regions like PayPal. Let's get into the actual DCF model now. Discounted cash flow is a valuation model used to value an investment today, based on estimation of how much cash business will generate in the future. Here is the DCF model built to value a company. I have used 2022 trailing 12 months results as base and assumption in previous slide to build DCF model. I will not go into the details, however, you can get access to valuation template at the link available in description of this video. The DCF model shows Paytm is valued at around $1,200 per share basis. However, we prefer to further discount intrinsic value by 20 to 30% to account for errors in estimation to get margin of safety value, which is around 850 to 900 range. Before I end this video, let me go into few risks and finally closing thought. Let's talk about risks first. Even though company is supported by big names like Alibaba, SoftBank, Berkshire Hathaway with deep access to capital, company can be exposed to significant risks. Paytm is young money-losing company which hasn't made any profit yet or even showed aspiration towards profitability. The company's capacity to burn cash will continue to expose it to the significant risk. This can lead to debt funding with high cost of capital or equity dilution to raise additional capital in future if profitability is not achieved in the near term. Lastly, company is facing tough competition from PhonePe and Google Pay in the person-to-person UPI app ecosystem. Remember, risk is not about volatility in share price, rather it's about permanent loss of capital. Alright, let's put some closing thoughts. The company has first mover advantage into the Indian mobile payment market, continuing to maintain market share in a growing digital payment market in India. As economies of scale kicks in, we expect company to reduce expenses, increase operating margin and rapidly scale up net income and earnings per share. In short, this can be perceived as good entry point for long-term investors who has rational mindset and big stomach to ride through the volatility and stay invested for longer time. If share price goes further down, investors should view it as an opportunity and take advantage instead of being fearful. Thank you.